Hello and good evening. This is Doc Severson for the ReadySetCrypto OMNIA trade of the day for Sunday, the 18th of April. All right, in today's video, what I'm going to do is really just focus on Bitcoin. This is the market leader, and as we look across, just about everything else is down today, with the exception of the almighty Dogecoin, which continues to hold support, consolidate after its unbelievable gains, and is apparently the only asset heading higher with few exceptions. There's other ones out there like Hero is still heading higher. But today, let's just focus on Bitcoin. This is what people want to talk about. And from what I'm hearing via email and Discord, this is what people want to hear. We're going to look at the price from a number of different angles. We're going to look at it from classic technical analysis techniques, as well as statistical analysis techniques, and we'll come up with a conclusion by the end of this. First of all, what I don't want to get caught up in is trying to explain why this happened. Why price happens or why price moves is usually because of fear. Somebody is under pain, and so they're taking action because they want to remove the pain. So always remember that first. If you always want to know why price is moving, why is it moving higher? Why is it moving lower? It's always because someone or some entity or some collection of people are in severe pain, and they're taking steps to reduce that pain. Think about this: if the price is heading higher, why would the price head higher? Why would there be pain with that? Well, there's two reasons for that. Maybe somebody is short and thinks that the price is going to be heading lower, and as the price continues to go higher, they feel more and more pain until they can't take it any longer, and they buy back their positions, which ultimately creates more demand, doesn't it? And those that are sitting on the sideline watching the price rally away are in incredible pain because they see the price going on higher without them and thinking, my God, this might be the last time that I can ever get on board at 38,000. And they have proven, psychologists have proven, that the pain of sitting on the sidelines watching a rally go by without you is actually more intense than actually taking a stop loss on a live position. So this is why price moves to the upside from pain. Now price will move to the downside from pain equally. Why would this be? Well, normally most moves to the downside from pain are because of fear of loss. So a lot of times people will buy in at the highs. Remember, these people sitting on the sideline, they couldn't take it any longer. They jump in at the very last minute because they're convinced that the price is on its way to 65,000 up to 100,000. And they don't want it to leave this station without them. And then all of a sudden the price starts to go down, and they're spending every waking minute looking at their smartphones, fretting about it. They can't sleep. And finally, they just can't take it any longer as their position goes well into the red, and they're shutting out the position at odd hours of the morning as they can't take it any longer, or stops are being run. Certainly that's usually the case. Now, I don't believe that price movement to the downside is also augmented by shorts sitting there watching this go lower and can't take it without them, right? So usually we get a lot of this long squeeze to the upside because there's a huge percentage of longs that are wanting to be on board and can't stand the thought of the price leaving without them. Very few shorts are feeling the same pain watching the price move to the downside. So this is why I always focus on just the price and not necessarily the news. The news can be contrived. People are searching for reasons for things to happen. And quite often it's just the mere movement of price, people being in pain, that starts the price moving, and it starts sort of an avalanche of cascade effects from the inside out. It's what I always say. Rule number 2 is reversals start from the inside out. Okay, so technicals, what's going on here? So the first thing that I want to bring up is my concern from a few days ago. Remember when we broke above 60,000? And this was I was viewing this as more of an ascending triangle pattern with a series of higher lows and essentially equal highs. And then we did get finally the breakout above 60,000. That's a nice big round number. People find it fascinating when price breaks above big round numbers like that, like 40,000, 50,000, 60,000. Remember 20,000, right? So this is a big deal when the price breaks out above a big round number. The problem was, and this is what I was complaining about earlier this week, is where the hell's the volume? Volume means that somebody's in pain, and there was no pain on the move above there. There was no shorts getting cooked. There were no people sitting on the sideline going, oh my God, I've got to get in here. So the price just sort of quietly broke above here, and this is a classic false breakout. And the big tell, the big signature behind that lack of being able to break out was the no volume. There's just no volume driving it. Now, I'll be the first person to say that is never 100% the case. Sometimes we'll see the price just sort of grind higher on very low volume, and nobody can explain it. Nobody can rationalize it. It just happens, right? You always believe the price. But if the price is not confirmed with volume, then you have to be suspect of the breakout. Number two, let's look at the price action. So when I say the price action, what I'm looking at are the pivots here. The higher highs, the higher lows, the higher highs, higher lows, higher highs, higher lows, higher highs. And what do we have here so far? This is still a higher low if we compare it to this major pivot. Now these lines here, these are moving averages. This is the 50 simple, and this is the 200 simple. And yes, I'm sure somebody out there in YouTube land is showing that, well, the 34 period exponential moving average is always going to show exactly where support is, things like that. Look, I'm not a big believer in using moving averages religiously like this. I do like to keep the 200 and the 50 simple around because they are a nice reference of where the trend is. That's it. Not really support and resistance, things like that, but just a sense of where the trend is. The 200-day is just a sense of the mean. If the price is above the 200, it's generally implied to be a longer-term uptrend. The price is above the mean. If the price is above or below the 50 represents more of an intermediate trend. And right now we have certainly an intermediate trend to the upside. What happens if the price closes below the 50 today? And we've got about 11 hours. I'm recording this early Sunday morning, so there's maybe 11 hours to go before the day flips over. A lot will depend on the close here, and I think people will watch the 50 to determine what's happening in terms of the close of today. But I would say if the price loses the 50-day, if we close below the 50-day moving average, no big deal. It's not the end of the world. We had talked about this over the last few days saying, look, if price can't break out, I think that we'll come back down to revisit this trend line in yellow. And so far that may be the case because we're getting awfully close to that. Okay, so 50,000 is down there. 50,000 also represents the prior swing low. So if the price undercuts 50,000 and closes below that and closes below this trend line, then maybe we have some concerns. Now, the other thing I want to bring up here is more of on a weekly chart level. And this is going to be the concept called the swing test. I'm going to bring this back here. And you can see this a little bit better on the weekly chart. We have this swing up here. So former resistance, which is at 42,000 in this case, becomes new support from above. So we have a swing test here at about 42 to 43,000. And that level needs to hold. Simply, we have range expansion here leading to range contraction. This is just more range contraction. But if we start to see the price undercutting 42 to 43,000, then that's going to be a bad sign. So not only the ascending trend line being cut, but also losing the price level 42 to 43,000. that's where I will become more defensive and I will start to sell positions into any kind of a rally. The other thing that I'm going to bring up is character, the character of the price. Again, this is just a weekly candle. This is the full weekly candle here. And you have to understand that this isn't that big, not really. So on a percentage basis, going from 52 up to about 65, okay, that's still normal in terms of the weekly range of the candle. What I want to bring up to you is, let's see if we can find this here. Let's go back and reset this chart. What I want you to notice is how the difference was at the end of 2018. I know a lot of people listening to this went through the bear market that began in 2018, the end of 2017, and said, well, man, I don't want to go through that again. Not again for me, man. I want to sell near the highs. I want to lock in my gains and not let that happen to me. But what I want you to notice is what happened to the character here. It got to be very noisy near the top, and there was a lot of intermediate highs. And look at this, within the space of, we went from 20,000 down to 6,000 in the space of 1, 2, 3, 4, 5, 6, 7, 8 weeks. So 2 months from the highs to an intermediate low. That's what the beginning of a bear market looks like. That's what a transition to a downtrend looks like. Now, when you compare that versus what we're going through now, that's just a wee little candle. So I would say, guys, you know, if we start to lose these levels, like, you know, low 40s, and we start to lose this trend line, yeah, we're going to know it because things will have fundamentally changed. Now, one more thing to bring up, and this is kind of the last line of defense for the technicals, is the fib retracement. So if we bring up the fib retracements of this entire swing, if we go back to where I think this whole swing began, which was last August or September, and we drag it all the way to the top, we can see that this week's candle has only just scratched the surface. This has only brought it down to a 23.6 retracement. You can see also that the 38.2 retracement comes in at about 44,000, which is very close to that swing pivot. So we do have a very important decision level that comes in from 42 to 44,000. So that level really does need to hold, because the confluence of not only the fibs, but also the swing test, to me, represents, if this market still stays strong, the price is going to stay above the area from 42 to 44,000 on BTC versus the US dollar. Now, one last thing from a technical perspective, sometimes we see the price attracted to the 200-day. Sometimes. Now, I'm going to go back and look at this and see if this has ever been the case. And really, the answer is no. I mean, we just had a lot of tangling around going on here during the midst of the bear. And we did not really any reactions to this. So again, I'm just going to use the 200 just as a price mean. In the equity markets, the 200 is widely followed. I don't think it's going to be as widely followed in the crypto markets. So I'm not going to worry too much about the 200. Right now, it's well below the price. Maybe if the price comes down to this 42 to 44 level, and by that point, the 200 joins it in confluence, then it's going to mean something. But that'll take a few weeks for it to get up into that area. Now let's move over to the statistical analysis part of this. This is where option traders think that the price is going in the future. And what I'm going to do is I'm going to move this vertical line out here to the 28th of May, which is one of the next major Deribit expiration dates. And I'm going to move this arc over here as well too. And that's going to represent the probabilities going forward of the price. So the upper level of the expected move from now to the end of May, according to Deribit and the option chain, is going to be 66,772. The lower expected move, the lower level of the expected move going forward, one standard deviation of price movement, is going to be 42,772. We have about a 12,000 point expected move, plus and minus, going into the end of May. It's going to be very volatile according to option traders. Okay, so there's the lower level set, and all I'm going to do is just bring out the cone to today's price, and there we go. There is our probability cone of 68.2% probability. So again, there's a probability of 68.2%, or the middle of the bell curve, one standard deviation plus and minus, going forward, that the price will be in this area by the time we get to late May. Now, notice where the bottom end of this range is, 42,000. Remember, that's one of the important support levels that we consider to be, for the near term, the price needs to stay above these levels down here. And this is all kind of coming into play here. If we see something, if we see the price coming down to this level, it's not the end of the world, because all that means is that more than likely this is a monthly pullback. Remember, I've talked about the monthly chart lately, and the fact that the monthly chart has gotten way ahead of everything else. Let's reset this. We have a monthly chart in severe exhaustion, needs a few months of repair before the price can continue the assault. And if you just look at this from just a stand back at the end of at the other side of the wall, right? Stand back at the other side of the wall. We've had 1, 2, 3, 4, 5, 6 months in a row to the upside. Do you think that maybe, just maybe, we can have 1 month of consolidation, maybe 2, maybe 3 months of consolidation to be able to acclimate the price to this level before the next leg of the rally kicks in? I think it's entirely normal to expect something like that. No volume, no breakout. Okay, just quickly, LedgerX, I was finally filled on my short put here, so I sold some puts and set up an aggressive target, and the price just sort of took in my limit order. And I'm glad that I didn't chase after this thing. I set a nice limit, waited for the pullback, but I did have to wait a couple of weeks, which seems like, you know, I had got to the point where I was almost ready to chase after this thing on a decent breakout. But fortunately, the discipline kicked in and nothing like that happened. So I've got a short put position. I'm obligated to buy BTC at a price of $55,000 per contract if the price is at $55,000 or lower by the 28th of May. This is my conversion machine to take dollars into BTC for the long term. Now, one just last final thing here, since I made a case here for the price to hold up above this level, I am going to front run any drop in the price to about 44 to 45,000 in this area. So I'm just going to hold out in a different account, like a Coinbase account, the Pro Coinbase account that we have. I'm just going to set up a good till cancel limit order in this area to pick up some more BTC if the price does drop down to this level. Again, strong confluence down there. I would be a willing buyer to pick up an additional stake of BTC down in this area in the mid 40s. All right, folks, I could probably go on and on with more technicals, but I think we've made the case right now in terms of what's happening with the price. And this is all very normal. This is expected to see this sort of thing. And the challenge for you as a retail investor is to be able to look through the fear, uncertainty, and the doubt that others create to make sure that you're not missing an opportunity. And also to separate an opportunity from what is a real risk. So hopefully this video has been able to help you separate what's an opportunity versus where we have to ring the warning bell here for BTC and for crypto in general. But until that point, there's Dogecoin. All right, have a great weekend. We'll see you folks here on Monday.